Hello traders, James Stanley with StoneX and FOREX.com. Next week is huge. We have multiple central bank rate decisions. There's even the expectation that a couple of these banks might lay the groundwork for a rate hike in the not too distant future. We also have the ongoing scenario around Iran and the Strait of Hormuz, which has had a divergent market impact. If you look at this in oil or even in the headlines, there's still quite a bit of fear. Look at this in equities, however, especially US equities, not so much. NASDAQ 100 futures set a fresh all-time high today. NVIDIA has been up more than 25% from the low of just a few weeks ago. Very divergent front on that. In this video, I want to look at strategy around the US dollar for next week, focusing on price action. I'm going to look at this from a few different perspectives. First and foremost, need to look at a risk disclaimer. I'm going to leave this up for 15 seconds up front, 30 seconds on the back, and it will be in the description field of this video. Please review that. Pause the video, take more time to review that if you so need. I will be on the other side and we'll start looking at charts. All right. So first and foremost, your directional stance on the dollar is likely going to be guided by time frames. From the weekly chart, we had the first green candle since the sell-off had begun as we came into Q2. But this is an inside bar. The entirety of this week's price action is contained inside of the prior week's price action, and this is a form of indecision. Now, given that we have elongated wick on either side, that also further points to indecision. You could probably even call this a spinning top formation, which, again, indecisive. But shorter term, or at least once we get down to the daily, this looks more like a bounce from a low that keeps the door open for bears. This, to me, seems very similar, albeit shorter term, to the backdrop that we had back in January and into February. And I talked about this quite a bit at the time because we had this oversold read in the US dollar. The dollar had gotten very oversold, 22.5 on daily RSI, which I believe was like the lowest in like 5 years. As I said then, if you want to get short the dollar, wait, look for some element of resistance and then take your shot, because chasing an oversold market, especially an oversold FX market like the dollar, challenging way to go about it. Well, that snapback found resistance right here. Sellers took their shot. That ultimately ended with a higher low, a reversion right back to resistance, and then the breakout as we had an ascending triangle formation that had brewed up. Right now on the daily, again, very similar, albeit shorter term. We had that massive sell-off that culminated last week. Last week we saw a 4-day grind that extended into this week at 97.94, same resistance as we had in February that led to the ascending triangle breakout. Friday was a liquidity clearance event. This week, very different tone. You look at the shorter term, that's where it starts to take on more of a bullish look. And that's because we had this initial higher high after the weekly open with a higher low right on the top of that zone, another higher high, another higher low, and then that extended all the way into Thursday trade. Friday, different story. We've seen that weakness hold on Friday, or weakness show up on Friday, and that's what gives us that upper wick on the weekly candle. But shorter term, this is still a higher high, higher low sequencing that could be construed as bullish. For long USD setups, I'm still partial to dollar yen. This is a setup that has held up very well, all factors considered. I mean, even when we had that influx of dollar weakness earlier in April, you'll notice that dollar yen held quite well. I mean, it's been range bound now for past month and a half. We had an open door for bears to go for a break, failed, failed, failed. Now, this also sets a possible trap, because when you see a support level that's held this well, there's likely some stops setting below that. And we have a major factor on the economic calendar for next week, early next week, with the Bank of Japan rate decision. Now, there's building expectation that the BOJ might be hiking rates in June. And if Ueda uses this meeting to highlight that, we could see a swell of yen strength similar to what had developed in January. Now, January was a messy situation, and this is one of those areas where I think social media could be very detrimental, because traders are often looking for the why more than the what. And the why doesn't really matter as much as the what. But I saw a lot of widespread accusation that there was a rate check from the Fed, where the Fed had called into banks asking how much dollar yen they were holding, kind of seen as a precursor to a possible intervention. I don't know how anybody would know that, but even if it did happen, it doesn't seem as though that fits the way that the price action showed. The price action itself showed up after a BOJ rate decision. Ueda sounded more hawkish than what markets were looking for. He sounded as though he was ready to hike rates, maybe even as soon as April, which we're not looking for now, but it's been extended to June. And then if you look at this long term, it's still a very one-sided trade. We're more than 50% above early 2021 values, and when you have something like that, that's driven by a lot of longs, a lot of demand that's still holding on. So that can lead to these up the stairs, down the elevator types of scenarios where you have a stodgy one-sided trend, and then when there's evidence that maybe the backdrop that's produced that trend is going to shift or change, now there's reason for all of those longs or some of those longs to cut bait, leading to a fast reversion. Well, we're back up near the same range resistance, and that is like a rubber band that's pulled all the way back. And this can really work in either scenario, and this is what puts so much focus on the BOJ rate decision for next week. If Ueda signals that he's more willing to hike rates in June, if he instills a hawkish lean from the BOJ, then this is something that could have a similar effect to what we saw back in January, where longs that are holding on very near that 160 level, they simply aren't attracted to the risk reward of holding on any longer, because if we get up to 160 and there is an intervention, well, capped possible upside. But if we are seeing the BOJ shift into a spot where they're going to be more hawkish, where they're going to raise rates more, there's even less reason to be holding on to those longs when we're so near the 160 level. If we get below that spot of support, I think there's probably a lot of stop orders. Stops on longs are sell to cover or sell to close, and that brings more supply into the market, a faster drop, and that's something that could lead to a down the elevator type of setup. That said, this isn't a one-sided thing. Ueda is not the type, hasn't been the type of central banker that's wanted to make waves if he doesn't have to. On top of that, there's some political intrigue behind it because Sinead Takeichi was very much elected on a pro-growth platform, and in the past, she had previously said that she thought rate hikes were stupid. When the BOJ hiked rates in December, it was almost as if her administration had given the bank like the blessing to do so. So much so that the response to that rate hike was yen weakness. So if he's not in a spot where he wants to make waves, if he does remain evasive, maybe he's less hawkish than what markets are looking for. Now there's justification for a 160 test. And if we get a test above 160, there's likely some stops on short positions. That's buy to cover logic. That's fresh demand that comes in the market that could lead to a fast push above that level. If we're going to see dollar strength play out next week, I think it's going to need some help from the BOJ. But this, again, very much an item of intrigue. Until this range breaks, I want to look for range continuation. I'm still following support right here in this zone. It's 157.66 to 157.90. I have an S2 right here at 156.39, and then an S3 from 154.45 to 155. Same zone of prior resistance, turn support for the December rate decision. If we get below that, I'm not necessarily looking to press shorts, but I could look at a bounce up to 156.33, or excuse me, 156.39, or this zone of 157.66, 157.90. I could look at those as possible lower highs for longer-term mean reversion types of plays. You look at this over the past couple of years, and it's basically been mean reverting. And we're at the top of that range. If we are to see that range hold, then there's possibility of range continuation. If we see that 160 level get popped, I think the run could be very fast. Above current resistance, 161.95 is the next big spot. That's an even 1,000 pips above the 151.95 level that had come into play back here that was defended in October of 22. Held as resistance in 23. And it's what ultimately has set the high in over the past couple of years in 2024. Above that, the next big figure, 165. That's the spot that I think would be like the ideal jump-in point for a Ministry of Finance order to the BOJ to intervene if we did get that breakout set up. But I think this is still the leading driver for DXY USD in whole. Also on the long side of the dollar CAD is a pair that I'm still partial towards. I looked at this in the webinar on Tuesday. So far, it's held support quite well. This is it's been kind of a feast or famine theme. We had the strong breakout in late March, strong reversal in early April. But when I looked at this in the webinar on Tuesday, we were right at this point of support, not a secret level or anything. It was simply a swing low from back here in December that had come back in as support again, and it showed as support earlier this week. If you go down shorter term, now we have the prospect of a possible turn because we had that. You can see over this 4-hour chart, we had really ardent defense at that level and then a quick higher high. Question now is whether or not we get a higher low that keeps that door open for a continued reversal of that short-term sell-off. But this is also on the radar for long USD setups going into next week. For short USD, euro dollar is still on my radar. That said, I don't have it at an ideal spot. I think that 116.28, 116.55 area is perhaps a little bit more attractive for that front. That said, we're still working within the confines of the long-term Fibonacci retracement produced by the 21 to 22 major move. This is something that has shown a number of inflections over the past few years. This is what caught the high in 2023 right at the 618. It caught the low last year right at the 236. More recently, it's been the 764, 786 expanse that has been just a brick wall for longer term bulls. You look at this on like a monthly or a weekly chart, there has not been a lot of progress above that zone. Shorter term, even off like the daily, there have been quite a few inflections off of those prices. 116.86 is what's trying to come in right now. But again, your directional stance on this is likely to be determined by your time frame. Daily, this looks like a pullback in a broader bullish trend. There's even scope for a deeper pullback down to like a 116.55, maybe even like a 116.28-ish. But if you look at this shorter term, this looks like a bearish bounce with lower high resistance potential right at the top, right around that 786 Fibonacci retracement, like 117.48 to 117.66. But this is what I'd consider invalidation for short-term bearish themes in the pair. So i.e. if you're looking to get long or if you're looking to be bullish euro dollar, you want to see bulls break above that, or you want to see liquidity clearance with a 116.55 test, followed by what could be looked at as a short-term bullish reversal setup. Also on the short side of the USD, cable. This is also high on my radar right now as we go into next week. This was a pair that was holding up fairly well until we had a late week breakdown. It didn't last, though. We saw bulls return pretty quickly thereafter, and this falling wedge formation had built as we had that support slowing down the sell-off until we had that capitulation move. This is similar, albeit tighter, than the falling wedge that had built earlier in the year. But the reason that wedges are construed in the manner that they are is because it's almost like you could see the waning bearishness playing in at these weaker swing lows. Bears are still taking their shots on pullbacks as evidenced by the more aggressive trend line at resistance. But when we're getting this, it's something where like a half-hearted bearish move could quickly turn into reversal. And so far on Friday, that's what's happened. It hasn't been a big down day on the USD, especially if we look at it from the perspective of euro. It's been really clean here in the British pound, though. A strong breakout. But the area that I could look to for higher low support is right in here. Prior support is from like 134.84, 135 flat. Pullback there sets the door for a higher low on the 4-hour. Looking for bullish continuation. If I'm looking for USD weakness going into next week, this is the one that I think stands out fairly well. But that, my friends, is what I have for next week. Like I said, action-packed week on the radar. As always, thank you for your time and happy trading, ladies and gentlemen.